Hi everybody, welcome to Deep Well Talks of Deepak Academy. Today we are going to explore something fascinating. It's not about the stock market, not about the economy, but our own mind. Because more than market crashes, interest rates, or global politics, it's our psychology that affects our wealth the most. So let me start with a simple question. Have you ever made a decision in life that you regretted immediately? Maybe you choose a career because everyone said it was safe, or you bought a product because the advertisement looked attractive. In that moment, what guided you? Often it's not the lack of intelligence, it's simply the shortcuts your brain takes. These shortcuts are called heuristics. They help you make quick decisions like picking a chocolate from a supermarket simply because you like its packaging or you have seen an ad on the TV. Most of the time, they are harmless and saves time. These shortcuts can turn into dangerous traps. These traps are what we call as biases, which are predictable errors in thinking that lead us away from rational decisions. It's like a glitch in our brain's operating system. It may be harmless in choosing chocolates, but when it comes to money and investing, the things get serious. The biggest danger in investing is not the market, because markets have its inherent property, but it's due to our own emotional reaction to the changes in the market. One moment of panic or excitement can erase years of hard earned savings, and many of our investment losses are not random. Biases silently push us into costly mistakes. Today, let's break down some of the most common biases that hurt investors so as to avoid any future investment losses. Let me start with availability bias, which is living by recent memories. This bias happens when we judge even based on how easily we can recall them or examples come to our mind. Think back to 2020. Tech stocks were dominating headlines. Stories of people doubling their money were everywhere. YouTube, WhatsApp groups, business news, etc. These stories were fresh and memorable. So naturally people thought, if they are making money, why not me? But availability bias makes us see only the visible winners, not the silent majority who lost money. We remember what is loud, not what is accurate. Next is overconfidence bias, the thinking that I can predict the market. Most investors believe they are smarter than average, which mathematically cannot be true. Overconfidence leads to excessive trading, taking bigger risk, ignoring uncertainty. Think of the dot-com bubble in the 1990s. Everyone thought they were tech geniuses. They bought companies that had no profits, no business plans, just flashy websites only. Then came the crash. Millions lost money because overconfidence blinded them from reality. Then there is herd mentality, which is following the crowd. You have probably seen this. Everyone in your office is buying the same stock, investing in crypto, or flipping real estate. And you start thinking, if everyone is doing it, it must be right. Here you are following the crowd instead of doing your own homework. During the 2008 financial crisis, people bought property simply because everyone else was doing it. When the bubble burst, the same crowd that bought together started panicking together. In investing, the herd is often late, usually just before the fall at the cliff. Anchoring bias, getting stuck on the first number. Anchoring happens when we fixate on the first price or value we see. For example, if you bought a stock at rupees 1000 and it falls to 700, you keep waiting it to go back to 1000. But the market does not care what you paid, but care about what something is worth today. Anchoring makes you cling to the past instead of evaluating the present. Another common bias is confirmation bias, listening only what you want. We tend to seek information that supports what we already believe. If you believe gold price will increase, you will see only those videos or articles or news that supports your belief and ignore anything that says otherwise. It feels comfortable emotionally, but it's dangerous financially. Good investors actively search for the opposite viewpoint. Challenging your own belief is how you protect yourself. Then we have loss aversion. Fear of loss hurts more than gains feel good. Psychology says Pain of losing rupees 10,000 feels twice as painful as gaining rupees 10,000. Feel good. Because of this, investors hold losing stocks too long. They sell winning stocks too early. Both decisions harm long-term returns. Successful investing requires accepting small losses calmly. Recency bias is overreacting to what just happened or giving too much of importance to recent events. When markets rise for a few months, people believe the trend will continue forever. After a crash, the same people will swear to stop investing entirely. Recency bias makes us prisoners of the moment. Long-term data, not short-term emotion, is what leads to wise decisions. Endowment effect is loving what we own too much. We tend to overvalue things simply because they belong to us. In investing, this means holding on to poor performing stocks just because we bought them. Emotion replaces logic. Sometimes the smartest decision is to let go and reallocate. Familiarity bias. Staying in the comfort zone or comfort zone trap or preferring what we know over what we don't. People prefer familiar companies, local brands, or the industry they work in. But familiarity does not equal safety. It often leads to over-concentration. Diversifying across sectors, countries, and asset class is the real risk control. Mental accounting. Treating money differently. It's all the same. We often divide money emotionally, like bonus treated as fun money, salary treated as serious money, IPO profits treated as experiment money. But the truth is, all money is equal. It should all move towards your financial goals. Where it came does not matter. Next is sunk cost fallacy, which is throwing good money after bad. This happens when we stick with a bad investment simply because we've already invested time or money. Example, you put a 5 lakh in a mutual fund that underperformed for years. Instead of switching, you add more because I have already come this far. But past costs are gone. Future decisions should be made logically, not emotionally. So, how to handle these biases while investing? These biases don't mean you are careless. They are natural human tendencies. But knowing them gives you the power to manage them. Step 1. Awareness. Pause when a decision feels emotional or rushed. Step 2. Discipline. Use data, diversify, set clear goals, and consider unbiased advice. So, investing is not about predicting the future or chasing trends. It's about consistent, thoughtful decision making and protecting yourself from your own mind. Understanding your mind is just as important as understanding the market. I hope today's video helped you understand your thinking patterns a little better and how to safeguard your wealth from the mental traps your own brain sets for you. Thank you.